All right. It is 2 o'clock on the West Coast. Very excited for this bonfire chat. For those of you who have been with us on our other bonfire chats or other webinars that we have done, this is one that is very, very timely. Today we're going to talk about the PPP and the Main Street Loan Program and things that have just happened in the news, and we're going to bring you some actionable items today that are things that you'll be able to take away and put into effect today, tomorrow, that's going to help you tax plan in a more effective way, and also give you some information that's going to help you plan for 2021 in a more effective and efficient manner. So very excited today. I'm Matt Garrett. I'm the CEO of TGG. We are an outsourced accounting firm. Our main benefit is actionable information on time that's accurate at a price that's 60 to 40% cheaper than full-time hires. And we just believe that we have the best talent. And with us today is one of those people. It's Bonnie Howard, who's one of the CFOs at TGG. She's a CPA with her master's in accounting. She worked in Big Four accounting for years before coming over here and realizing that consulting was better than compliance, and helping people was better than telling them they suck. And so Bonnie is someone who I absolutely love working with and love speaking with. She, from the beginning of this, if you have been on some of our other webinars with the PPP, has been one of the leaders inside of TGG, drafting our response to get out to all of you and the community at large as to what was going on with the PPP and the Main Street Loan Program and all the various changes that came with the CARES Act and all the stuff that's happened in 2020. I swear 2020 feels like it's been 10 years long. But we are here today, and so I'm excited to talk about the PPP, the Main Street Loan Program, and tax planning here at year end in lieu of what the IRS's most recent pronouncements are. So what I want to do here, and actually before we get started, I've got to do a little plug for TGG Analytics. We are very excited to introduce TGG Analytics, which is an automated system for doing your financials, and we're going to price it out on a SaaS basis. It's going to be extremely inexpensive, but if you sign up now or join our wait list for it, you get the first 3 months free. And these are TGG way financials, very high professionalism, things you can give to bankers and CPAs to get your taxes done, all that sort of stuff. There is a link, in the chat to this. So if you would like to automate your financials in an inexpensive way that gets you extremely professional looking financials, please go there, sign up. We'd love to have you. And again, the first 3 months for free for those of you who sign up today on our waiting list at tgganalytics.com. Next, we also have launched TCG University. We've been doing this now for several years internally, where we do tons of training for our accountants internally. We are now starting to give certificate level programs for external accountants as well. So if you have internal staff who you think could use a little bit of extra training, we are giving certificate programs all the way from a staff accountant all the way up to CFO. And we're going to be rolling out in 2021 a number of industry specific certificate programs, including construction and manufacturing, service businesses, nonprofit, et cetera. So we are excited to really publicly launch TGG University. We've done a handful of test classes this year, and that's going to get started in 2021. Okay, you ready, Bonnie? This is going to be.
Let's do it.
All right, so we all know what the PPP was. We don't need to get into that. We know that it's this program that the government gave out. We know that they said, hey, this is stuff that if you use it for forgivable expenses, which were, things like payroll and things like occupancy costs, if you used it like that, it was not going to be taxable. The forgivable nature of this was not going to be taxable to you. Now we learn the IRS is taking a totally different stance and changing the game for us. What just happened? What was the latest IRS pronouncement?
Sure, Matt. And I want to say thanks so much for having me today. This has been what I've been thinking about, talking about since March, and it has been a lot of this hurry up and wait. So the timing of the IRS's recent pronouncement is really no surprise with what we've seen this year. So what came out a couple weeks ago is the IRS made a decision that says, regardless of whether or not you've applied for forgiveness in 2020, if you expect forgiveness on your PPP loan, the expenses that are going to be forgiven are not tax deductible. So this is different from before, because previously we understood it that these expenses, we knew they wouldn't be deductible if you had applied and received a decision on forgiveness. Now it doesn't matter if you've applied. If you can reasonably expect to obtain forgiveness, you're going to apply. These expenses are not deductible.
So, all right, so we have now a situation, a lot of people sometimes don't understand the difference between deductibility and non-taxable, because the loan is still, if it's forgivable, is still not taxable to you. But the expenses being non-deductible is the same thing, isn't it?
Exactly. Yes. So in other words, the PPP loan is taxable.
Okay, that's that's what I understood it to mean. I just wanted to make sure we're on the same page here. So,
right.
All right. So if this is the case, is there? Do we still want to try to get forgiveness?
Absolutely. I'll go ahead and give just a cash flow example.
Sure.
So let's say you get $100,000 loan. If you apply for forgiveness, if there's a effective tax rate of 30%, you'd be paying $30,000 on that. Okay. If you choose to not apply for forgiveness, you'll take on the debt and pay out $100,000. So that's $70,000 more if you're not applying for forgiveness. So I would say the worst case scenario would be to take on the debt, and the best case is going to be some of the stuff we talk about today.
Okay, so then let's get into this. So there might be a case. I really brainstormed this myself, and I could not think of one. I had to call some tax attorney friends, and actually ended up calling my 47-year veteran tax attorney father. I've got to give him some credit in this, because he and I had like a 2-hour conversation about this yesterday. And I said, Dad, when on earth would it be advisable not to try to get forgiveness and then to take the deduction? And here's what he came up with, which I thought was pretty interesting. It's a 1 in a million kind of a situation. It's where you've done well enough to maybe have some taxable income this year, but you might be in a service business and you're expecting things to bounce back next year, but you don't have any cash, and you've used all of that money. And so you really just want to postpone the paying of these taxes, and then you just use it as a loan in order to cash flow. And it's like a last resort, the very last thing you could think about. And that was what he came up with. And I thought that was probably the only situation that I could think of where you wouldn't want forgiveness. Is there any other I don't know, situation where you can see that being beneficial? I couldn't, and my father and I couldn't figure one out.
I mean, I did think about this as well. And what came up for me was kind of a similar situation is, if you can expect to have a really good year next year, like, that, you can never know that certainly, right? But if that's what you're leaning toward, and again, you are in a position where you do not have the cash today to pay that. And if you're looking out 13 weeks, you don't expect to have the cash to pay for that liability, then kind of the same thing, right? But there's definitely going to be some story elements in there depending on your business, where you're going, and where you are today.
Yeah. So I just got a couple of messages here in the chat, and I want to encourage everybody out there to express whatever it is you want to express: frustration, questions, other kinds of things, because we'll kind of feather these in as we talk about this. The first one came through, and it said, many of us took the loan expecting our expenses to be deductible per the original guidelines. By the way, I did too. We all did. So I completely agree and feel like the government did I don't think they're being fair with what they're doing, because it said, how many of us would not have taken the loan if we knew about this? And I want to address this really quickly, because I think it's a good point of frustration, and a reasonable point of frustration. I'm frustrated too. But to your example, if I got a $200,000 PPP loan and I still get forgiveness, I'm still netting $100,000 essentially free from the government, right? If my tax rate's 50%.
Oh, correct. Yep.
Right. So net, it's still better to take it and still better to go after forgiveness, correct?
Correct. Yes.
All right. So let's talk about this then in terms of action steps, and what are the next action steps that we should take here, like immediately, meaning before year end? What are the things we've got to get done? And by the way, if you're listening out there, this is the time to take your pencil out and take some notes, but also anyone who signed up for the webinar today will get a recording of this, so you can re-listen to it. But we want to give you some really actionable items that you can take away.
Perfect. I do want to point out before answering that question that, this is a little bit of a battle between the Treasury Department, IRS, and Congress, right? Congress wrote the CARES Act, and then the IRS, US Treasury Department, separate, is coming out with this guidance on taxes, which is why initially, we all knew, as we read in the CARES Act, that the forgivable amount wouldn't be taxed as income. So it is a little bit of a battle that's still going on. As far as answering your question on what can you do today, so attending this webinar, first thing, is a great first step. I would say to start planning. And there's a couple things that I think are really important to understand about your business when you're looking at taking some of these next steps. And one is, as of today, what is your projected taxable income? Okay, and this might be something that you can meet with your CFO to discuss, your tax CPA or tax preparer to understand. Are you in a position where if you've had a bad year, do you have a loss? Are you already at a loss, right? You kind of want to understand that first. What's your base point to know what is this addition of income from the forgiveness? What is that going to do to my taxable income? Okay, so that's going to be really important to understand upfront. Second thing is to understand how much cash you have available, right, today to be able to cover that potential increase or new tax liability. So those are kind of two things. One is what's going to be your cash outflow, right? What's the expected tax liability? And two is where are you at with cash now? And then kind of what are some inflows coming in? So I think those are really important to understand off the bat. And then as far as action items go, I did a little bit of geeking out, looking up tax provisions in the CARES Act. And there are some really favorable provisions in there that didn't get as much popularity, I would say, as the PPP loan did. And so I want to talk to you about a few of those things. A couple of the first ones we'll talk about are going to result in basically immediate refunds once forms are filed. And so one of these is the new rules, or the modified rules the CARES Act allows on NOL carrybacks. So this is net operating losses. So the CARES Act allows you to now carry back losses 5 years. So this was previously not something that you can do. And you can do this for tax years 2018, 2019, and 2020. So I already have a client that has received a pretty significant refund related to their 2018 return. Something else to point out on this is that by carrying back, let's say, a 2018 net operating loss 5 years, you're most likely going to be carrying that back to a year where you had a higher tax rate, right? That would have been the Obama administration. There would have been a higher tax rate. That means bigger refund. Okay, so these are definitely items that we can take advantage of if that's relevant to your business. Second, kind of on a similar note, is the CARES Act allows companies to take 100% of the excess corporate AMT, so alternative minimum tax. Previously, this was capped at 50%, and now it's allowed to go up to 100%. So these are both special provisions that, with filing the forms, meeting with your tax advisor, you can send out and would result in refunds, which is cash flow in, right? So that will help you with the tax liability for 2020.
And that also helps you because my understanding here is what we want to do is file for forgiveness as soon as possible, right? Because whether we file or not, these expenses that we had are non-deductible to us. So we'd rather know sooner rather than later. The next thing that I think a lot of people are concerned about here is paying their estimated tax payments. because we've got an issue here where estimated tax payments are going to need to be made between now and January 15th. So I love what you just said, Bonnie, in looking at all options to increase cash flow, including backfiling 2018 and 2019 returns to get some refunds on, and looking back to those. Should people pay estimated tax payments before January 15th, and what's the best way to do this?
So, I mean, the best guidance on this is to follow the law as far as paying these estimated tax payments. I do want to circle back to something that you said on applying for forgiveness as soon as possible. Yeah. This is definitely our guidance. And there's another point that hasn't been mentioned yet, that the IRS also provided a safe harbor. And so within this revenue procedure, the safe harbor is such that if you apply for forgiveness and only receive partial forgiveness, then the taxable income piece, right, that is the expenses you can't deduct, are only going to be for the amount that is forgiven. So very important, we want to apply with a 24-week covered period. We're hoping that we get full forgiveness. But if there is a case where you're not getting full forgiveness, there's a safe harbor to say you won't have to pay tax on the covered expenses that aren't forgiven. So I want to point that out for sure. And then, yeah, to your point on planning for the estimated tax payments, you can also look at where do we have an ability to, if we do have some cash on hand, how can we balance that between prepaying any expenses to reduce our tax liability, or contributing that to an estimated tax payment?
Okay, so here's what I'm hearing you say. We want to try to hit. I mean, for me, for example, I just talked with my CPA the day before yesterday, and I have a number that I have to pay before January 15th to penalty proof myself. There's a lot of people who are asking questions here. I'm getting a ton of questions from our audience here today about is Congress still talking about this stuff? Is there going to be a new stimulus package? Is there going to be something changed in California versus other states? I don't think we can bank on any of that. So my advice to people is to penalty proof yourself, file for forgiveness as soon as possible, and then don't file your taxes. Extend out until September 15th, because there may be something done on this. I think if you're feeling a little pain in your gut right now because you just heard that all that PPP money you took is now taxable to you, think about the rest of the country. I'm sure they're feeling the same thing. And my guess is that this is not going to sit well with businesses across the country. And there are going to be people speaking out on it. And there's a chance that it could be reversed or changed because, like you said, Bonnie, we have Congress on the one hand trying to do one thing and the Treasury Department and the IRS on the other hand kind of battling it out, right, and trying to do something different. What other ways are there, though, that, again, may not apply to everybody, but what other ways are there? I heard something about AMT. Can you explain to me, is there a way to get some more cash out of the change that the CARES Act for alternative minimum tax?
Yeah, so the CARES Act allows you to claim 100% of the excess AMT credits. If you don't know what this is, this would definitely be something that you could see on your tax return, your tax CPA would know about, and it extends it from 50 to 100%. And a credit means that's all coming back to you.
No, that's another place where we can maybe refile and get more money back from back taxes. Yes. There is a good question here, which was, if I can't pay by January 15th and I'm going to get hit with interest and penalties, am I better just taking the loan?
This kind of goes back to the initial point that we talked about, and really thinking about what's the difference in the cash that's going to be paid out, over, let's say, the loans are 2 to 5 years, right? So if you take the loan, you've got, and Matt said the $200,000 example, that's $200,000 that you could be spending elsewhere on your business, right? And then versus whatever the penalties and interest are, which would be a fraction of that.
Yeah, I think the bottom line is that a loan is still free money, or a loan is still required to be paid back. And if you're in a 50% tax bracket, just because it's easy for me to do the math when I do this, If you took a $100,000 loan, you have to earn 200,000 in order to pay it back, because no matter what the interest rate is, even though it's only 1%, the fact of the matter is you're going to earn 200, you're going to pay 100 in tax, and then you're going to pay off the other 100. Whereas if you just took that full $100,000 into income, and then you had to pay, call it $12,000 in interest and penalties on it, you're still only taking, call it 62,000 in total tax, as opposed to 100,000 in total tax. You're still much better off. But man, it's really frustrating, isn't it? I mean, I can feel like coming through a lot of these questions and comments, the frustration in business owners, and I know I'm one of them. It's pretty ridiculous that we're in this. So all right, let's talk before I want to go into some specific examples of companies that are either in a positive position, because we do have a lot of businesses that have made more money this year and have actually benefited from COVID. And then we have the opposite as well as true. We have a lot of companies that have actually had a poor year. And I want to talk about some tax planning. But before that, what are some key dates that we need to all kind of make sure that we hit?
Great question. So as Matt pointed out, so estimated Q4 tax payments owed are going to be due January 15th. So Matt did mention that, you can cover yourself on penalties and interest with that. Some of the other dates, I have to look at my cheat sheet here with all the tax dates, but the other key dates really are the filing dates for tax returns. And that's going to vary depending on your entity type. So March 15th, partnerships and S-Corp returns are due. You can file an extension that would take you out to what Matt pointed out, September 15th. Which is what we would recommend, right? You're literally buying more time here. That gives more time for a potential, right? We're not going to rely on it, but for potentially Congress to pass something that that helps offset what the Treasury Department is doing.
Yep. Now,
and then,
go ahead.
Oh, I was just going to say then the other dates for corporations and individuals, April 15th, and then extension to
all the way to October. Sure.
Yeah.
So the other thing that seems to me that is really important is that we figure all this stuff out and get our filing done here before the end of the year, our forgiveness filings, which have to go back to our banks where we got these. There was another question on here that asked about sole proprietors. Can you just address that for just 2 minutes here? I know it doesn't necessarily affect everybody, but sole proprietors. And then what I want to talk about is cash basis taxpayers, because I think most of our listeners are going to be cash basis taxpayers. But let's just do 2 minutes on sole proprietors and what they need to be thinking about.
Yeah, so for sole proprietors, self-employed, there was a maximum on the loan amount that you could receive. So I think it was $20,833, right? What you should be thinking about is the way that you distributed that money back to yourself. So if you transfer that as a distribution to yourself, then that is going to be a distribution, right? So it's not an expense to the business, be a distribution. So not quite the same things to be concerned about there. Not
exactly the same stuff, but still eligible for forgiveness and something that you want to make sure, because this is another thing that we have here. I've got another question from sort of our audience. If you haven't recognized the loan amount on the P&L yet, is it expected to recognize those funds as additional income or a reduction in expenses? This is a bit of a technical question, but it's a very valid one. And it highlights the difference between what we do in tax and what we do in the books for accrual. And so it's a little technical, but I want to make sure people understand this, because when you got the PPP money, you should have put it on as a loan. But now that you've gotten forgiveness, you want to put that money into other income, right? And take the loan off the books. Well, so now we're all here, but now we got to wait and go back and take some of the expenses off the books. Do we do that? Or do we just do a book to tax recognition? What's the right way to do this, Bonnie?
Great question. You do not take those expenses off the books. This is a book tax difference. So this is something that will be added back. These expenses will be, so we can think about it, right? The two ways: removed, added back on the tax return. Your books will stay the same, right? Because we still want the books to reflect what is actually happening in the business, because that's what we're making decisions on.
Good. So don't go back and change your books is the answer.
Right.
Do not change it, right? Go ahead.
Yeah,
sorry, Bonnie.
recognize the income to your point, take the loan off the books, recognize the other income, right? Non-operational income for book purposes. But that's all you're doing for book.
Okay. All right. So keep your books clean is the message with that. Do not change your books for tax purposes. Make sure you keep your books clean for operating purposes, and then keep a spreadsheet on the side or a piece of paper or whatever you do that says this is how we got from book to tax. And the tax return, is that still I think that's an M1 adjustment, isn't it, on the tax return, if I remember correctly?
Correct.
I think that's the term. See, all right. I remember a little bit from tax, not much, but a little bit. All right. Let's talk a little bit here now. I want a scenario plan for people, and then we're gonna slow down and finish our part of this. And I'm just gonna take more questions from our audience here. But what I want to do is, what would you be doing right now if you had an off year? So you had an off year. Let's assume you're an S corporation, sole shareholder. You lost money for the year. What is your best solution here between now and year end? You're a cash basis taxpayer, which I think most of our folks are. What's the best way to do this?
So to start, we got to understand if you're currently at a loss position that is more than the income you're going to have to be adding back for the loan. So I almost feel like you have to branch that off into two different situations.
Cool. Let's hear it. I think that's a great point.
Okay. So because I do have clients where it's going to be the case that this recognition of income for the PPP forgiveness is going to put them in a taxable income position when the entire year, we've been expecting a loss. And if you're a partnership S Corp flow through entity, then that is going to get passed down, right, to the owners of the business. So if you're in the case now where you're going to be in a taxable income position, you can take advantage of the filing back taxes, right? That's not going to affect your current tax liability, but that is going to help with cash. There are a couple provisions in the CARES Act that are going to be helpful this year, if this applies to you, as far as your 2020 return, that are going to help reduce your taxable income. One of those is that the CARES Act now allows up to deducting interest up to 50% of your adjusted taxable income. So before, you could only deduct up to 30%. So if you're highly leveraged and you've got a pretty big interest expense, you can now deduct more of that expense. So that's going to be really helpful. Another piece here is that the CARES Act allows you to take bonus depreciation on qualified improvement property. So this is a type of capital expenditure where you're making improvements somehow to the interiors of the office or real estate. And now what you can do is go back 2018, 19, 20, and you can take accelerated depreciation on that. Previously, this wasn't allowed, and it was actually an oversight in the law. So the CARES Act corrected that. And so depending on how much you're spending on qualified improvements, that can be a pretty big amount because you could basically write off the entire purchase.
Yeah, those are all huge things. There's another thing in there, the bonus depreciation up to 100% of qualified equipment too, right? So we could actually go in. One of the things I was thinking about for people, let's take your situation. You were in a loss position, but now the non-deductibility of the PPP puts you in an income position, income taxable situation. There's to me, there's those things. I love what you mentioned about the interest deduction and some of the other things in the CARES Act. But there's also a couple of other things I think you might want to consider, which is stop paying your bills. If you're on a cash basis, hold bills back and release them all on January 1st, because you're a cash basis taxpayer. If you don't spend the money in 2020, that's going to increase the amount of income you might have. So if you're at a loss position, it's going to get you there. Or prepay expenses if you've got a little bit of an income to get you down. The other thing that you could do, at least in my mind, would be also to go out and buy a big piece of equipment or a vehicle, something that you can do and you can buy on credit. Because if you can buy it on credit, it helps you with cash, because you can expense the whole thing in 2020 and yet still not have to come out of pocket with the cash. So you can get yourself back into a non-taxable situation. What if, Bonnie, you're in the opposite situation? What if you're negative, you're losing money, and the non-deductibility of this PPP doesn't even get you to taxable income? What do you do in that situation?
So in that situation, you already have the benefit of you're going to be able to carry that net operating loss that we talked about because it applies for 2020. You're going to be able to carry that back 5 years, right? Which could put you in a higher, a year where you had a higher tax rate. So if you're in that position, don't stop there, right? If you can increase that net operating loss, it's going to be a bigger refund. So I would almost say that that's, you know, an unfortunate circumstance as far as how the business operated, but from the tax side, that's almost a good place to be in. And you can do some of the things, Matt, that you just said, as far as either prepaying to make that loss bigger, right? Add expenses there, and then take advantage of some of the other, you know, the increased interest deduction, bonus depreciation. The bigger the NOL, then the bigger refund you're going to get by carrying it back.
So this is something that I hadn't even thought about, Bonnie, and this is why I love having you on here. What you're saying, if I heard you right, an NOL is net operating loss. So that means I took a loss. So if let's say I lost, I'm just going to use a round number. I lose $100,000 in 2020. After all this non-deductibility and everything else was taken into consideration, I can go and apply it back to 2019, 2018 returns where I might have had a 50% or a 40% tax rate, and I can get cash back immediately.
Correct.
So this is huge. I think this is really important for folks who might be in a bad situation this year due to, you know, whatever circumstances happened. This is a really important stuff. I think that's really valuable stuff. What about if I'm in the opposite position? I mean, we have a client who I know I won't go into too much detail, but is a manufacturer of something that has just gone through the roof and gotten a ton of sales. And she's doing just incredibly well. So with her, what's your best advice? Because now it feels like the PPP money, maybe she shouldn't have taken it all. And we kind of went through that. You take it no matter what. It's still free money, but and don't convert it to a loan. But how do you figure out cash planning for that? I mean, that's another really challenging situation because maybe in her case, I know she's buying inventory. And so she's in a low cash position, even though she's growing. So what do you see as an alternative for those folks?
Oh, that's such a good question. Such a good question. If you're not already doing this, I would definitely recommend planning out your cash flow weekly, looking out at least 13 weeks at a minimum. This is something that we do for our clients here. Look at where you can reduce expenses. Okay. So you would be really surprised when you go through and you look at who you're paying, what vendors you're paying. You might say, why am I still paying this? Right. So start to look at that kind of stuff, start to see where you can reduce those expenses. And if it's an inventory based business, there's a lot of, I could talk about that for an hour and bore you all, but there are definitely things we can look at with inventory to make sure that we are optimizing it. Okay. So that we are keeping what we're selling, right? And are we taking advantage of, you know, discounts on purchases? And, you know, I would say congratulations to that business. And it has been so fascinating to see which industries have done really well in this environment, right? And I would say, I mean, we would still say to not take on the debt, right? To still apply for forgiveness. You would have to be in a situation where your income is so high that, you know, the addition of this, you know, forgivable amount would make the tax liability greater than the debt, which we don't think would ever happen. Like it's impossible.
I think that would require a tax rate of over 100%. So I don't think that, because even if they give you $1 and took away 99 cents in tax, you still have a penny left over. So I think it's frustrating, but I think that's the emotional response. Okay, so those are some good things. Look, I've got a ton of questions here and they keep rolling through. So guys, we will get to all of your questions and we will stay late to make sure that we answer them. One thing I just want to touch on here real quickly is the Main Street Loan Program, because that it was a phenomenal program for businesses, but banks didn't really buy into it very much. There's only a handful of banks who are lending on this that I know of. And the reason is that they just didn't put enough juice in it for the banks. The banks didn't get enough fees out of it to make it worth their while to do. So, but a handful of banks are still doing it. So what do you know about the MSLP, the Main Street Loan Program, and what do our clients and listeners need to know about it?
Sure, that's a great question. So the Main Street Loan Program can be a really good option for companies, and it basically offers, it expands the pool of eligible borrowers because you can have up to 15,000 employees, whereas the CARES Act was capped, or the PPP loan was capped at 500, right? So it's now expanded to a bigger base. And over time, they modified to say that the minimum loan amount would be $100,000, okay? If this is something that you have not already been discussing with your CFO or your banker, do that today after this call, tomorrow, to see if this is a good option for you, because we are coming up quickly on the date where they're going to stop accepting applications. And so the last thing I saw said that lenders, so first of all, finding a bank that's participating in this is something that you'll have to do, but lenders have to submit the eligible loans by December 14th. So that's 11 days away, and no loans will be issued after December 3rd or 23rd.
Got it. So we've really got to hustle. If you guys are out there and need a bank that is providing these loans, we are and have been keeping this whole year since this program came out a list of banks and the banks that are doing this. The Treasury Department announced just about a week or two ago that it is not going to fund the Main Street Loan Program for 2021. Now the Fed was pretty upset about that, so there may be some more debate down the road. But as of now, there will be no commitment letters issued after December 23rd, and no more funding after the 31st, is my understanding of what's gone on. So important to hustle up and get on that if you can before year end. And again, we've got a list of banks.
And yeah, okay. And again, on that too, I know I have a lot of clients that are really debt averse. I get that. I don't like to have a lot of debt personally either. The terms on the Main Street Loan Program are pretty favorable. The principal's deferred out 2 years. So you're not going to be paying back the principal portion of that loan for 2 years from issuance. And then interest also is deferred out a year. So there basically won't be a payback period for a full year, which is something to consider when you're thinking about, long-term planning cash flow.
Yeah, that's another good point. All right, let's take some time to dive into our questions here. We just have a ton of them and more keep coming in. So a comment, I know this is something we've talked about, but I want to just bring it up again because this is a different type of business. This is a government contracting business, and it says forgiveness may not pencil if you have substantial government contracts that have FAR accounting, FAR accounting. Do you have a comment on that?
Sorry, what was that question one more time?
It said forgiveness may not pencil if you have substantial government contracts that have FAR accounting. And I think what they're getting at here is if you have cost plus government contracts, I'm thinking about this. I don't know how it wouldn't pencil, because I'm just trying to think through. You're getting free money if you get forgiveness. But if it's not deductible, I think it's going to be different for tax than it would be for your governmental accounting. I still think you want forgiveness. But for the person who sent that, I won't call you out. Please shoot me an email, or Bonnie an email after this. Our information will be there. We'd be happy to research this for you, or really get a better understanding of what the question's asking, so we can help kind of guide you into making the right decision with that. Because that's, I think on the surface, I still think forgiveness makes sense, but it's kind of hard to tell. All right, let's see here. If you have time, would you comment on the California, this is somebody from California grants, tax credits, loans, and et cetera, that Newsom just announced for small business. So I'll take just a second here to do this for those of you who are in California, because I'm not political about this, but I'm not sure anything Gavin Newsom says I trust. That's not because I'm a Democrat or Republican, it's just because he says a lot of stuff. So here's what he announced. He's announced that there's a 3-month extension for taxpayers filing less than $1 million in sales tax on the return, and extend the availability existing interest and penalty free payments to companies with up to $5 million in taxable sales. In addition to that, there is a grant of up to $25,000 to underserved micro and small businesses, although those were not defined in the bill. That will be available through the state in early 2021. Nonprofits are also eligible for these grants, and the California Office of Small Business Administration is establishing the program and make it available to small businesses as soon as possible. So we'll have to stay in connection with that office to try to figure out if these are things that you're eligible for. Unfortunately, the stuff that I researched with this is a lot of just sort of puffery. There's not a lot of details, and it's very different from the CARES Act, where we had very strict, this is exactly how you go get the money and do these things. Right now, those are not, the details are fuzzy at best. All right, here's another question that I think will be right up your alley. For clients using QuickBooks or other ERP and have cash accounts set up specifically for the PPP loan, is the best strategy for tracking those non-deductible expenses to look at the outflows from the account and examine the split to see which expense accounts / amounts were impacted? Sorry, that was a long question, but I think I'm thinking.
Yeah, this is a great question. Right when the CARES Act came out, our suggestion to companies was to set up a separate account to move the funds that you received into, to be able to really easily track expenses that were paid out. Beyond, as far as QuickBooks or the ERP system goes, if you're tracking it in there, great. However, the way the CARES Act is set up and how you have to track these expenses, particularly payroll, it's at the individual level. So you're not generally going to be able to do this in your ERP system. So TGG has a product. We have a PPP loan forgiveness tracker that's built out. I've helped clients use it. It is awesome. Some of our Excel wizards helped build it. And it helps you track at the employee level. So it's hopefully that kind of answers your question, in that if you're looking at total amounts, it can be helpful to track that through the ERP, but really you're going to have to be using something separate outside of your accounting system to comply with the CARES Act. Oh, you're muted, Matt.
Oh, don't worry. I do that once a Bonfire Chat, so this is just one more for me. I'm really good at that move. This really leads us to another thing, though, in this situation, which is I've had a number of people who've said, I haven't necessarily used all my PPP funds, and I don't think I will. I'll just give it back. I want to encourage everybody here to really use these funds and use them all up before the end of the year. There are a number of safe harbors inside of the updates to the PPP program that the SBA put out that allow you to not have to rehire all of the people if you were material impacted. So if you have questions as to whether or not you can get forgiveness, remember, even if you have the expenses be non-deductible, it is still some kind of free money for you. It's better than nothing. So if you have a question about forgiveness or how to use the funds here between now and year end, I would strongly encourage you to reach out to Bonnie or myself. We'll get you to somebody. Bonnie's an expert in it, but I can get you to Bonnie or somebody else who can help you figure out how to use those, because you got to use them before year end, and you got to file for forgiveness as quick as possible. All right, here's the next one here. As an S corporation received PPP funds and used 100% PPP for payroll, rent, and that's where the question ends. As an S corp received PPP funds and used 100% for payroll, rent, and other forgivable expenses, what impact is this to this person's tax return for them? They're an S corporation. I'm assuming filing on a cash basis. What does this mean to them specifically?
So it sounds like a scenario is described where you've spent the PPP funds as dictated by the CARES Act, which, as a reminder, guys, you have to spend 60% of that on payroll. So if 60% of that's spent on payroll, the rest is on occupancy costs. This means that you can reasonably expect for forgiveness. So for your situation, this will be added back as taxable income.
Yeah.
If you're an S corp, it's going to pass through to the owners.
Which means you got to make that estimated tax payment by January 15th of at least that penalty proofing, so that you don't get hit with penalties and interest if you can do that. This is an interesting point. We will get a double hit from the non-deductibility because our labor for R&D tax credit will also be reduced, thus reducing our current year credit amount as well. This sounds like one of those things that go ahead, Bonnie. Looks like
I will have to look into that more. I did not see that the labor, I think the R&D credit is treated separately.
Well, that'd be really good for this individual. And so for the person who wrote that question, again, make sure you reach out to Bonnie. Some of these things I know are hyper technical, so I apologize in advance, but appreciate everybody's questions. All right, this person says, why stop paying bills? Can you explain further? I think this goes directly to when I said you should withhold bills to increase your income for 2020.
Right. And so if we're talking about taxable income here, this basically just means if you're on a cash basis for tax, your expenses are going to be the cash that's paid out. So if you're pulling back on paying expenses, while your books, those should be accrued for and will impact your book income, right? For tax, those aren't going to be deductions until 2021.
That's right. I think my point in saying that was if you're in a loss position, you want to try to get as close to break even as possible for tax purposes, because then you can put some of those other expenses into 2021, where we have a new administration coming in. We might have new tax rates. They're definitely not going down, maybe going up, maybe not. But at the very least, you'll be pushing expenses into 2021 where you might have additional income that it could offset. And so if you're in a loss position for the year right now, you want to try to get as close to break even as possible. Almost everyone on this, I'm sure, is a cash basis taxpayer, but you're doing your books on an accrual basis. So you want to hold bills back until January to increase income and get you as close to zero as possible.
Yes, right. Thanks for closing the loop on that.
No, yeah, it is complicated. This stuff is not easy, but ultimately our job here is to make people money and help them achieve their goals. So that's what we're trying to do here today. All right, this was a good one. Can you carry 2021 capital expenditures or improvements back to 2020? We have a large capital project that's finishing in Q1 of 2021.
This is such a good question. I have to look at my notes for a minute here on capital expenditures.
I think my first advice would be try to hurry up. Like, if you push as much of that, if you can prepay for this and write the checks in 2020, even if you're just writing the checks and you're a cash basis taxpayer, you're going to be okay. So really think about what you can do to front end load that capital project to try to finish it in, not complete necessarily if it's like construction, but really try to front end load the expenses into 2020 if you can.
Yep, agreed.
Cool. And I don't know the answer. I just don't know the answer if you can carry 2021 expenses back into 2020. I don't believe so, because I think what it is you can carry 2020 back into 19 and 18, but I don't know that you can actually go the other way. So in the future, I don't think that was contemplated.
Yeah, I think the question is if 2021 can be carried back to 2020, which I'm not sure. So I really like your advice on pull that into this year if you can accelerate that.
As best you can, for sure. Okay, here's a good question. If you recognize the loan as income for book, you have two M1 adjustments, ? Not recognizing income for tax and not recognizing expense for tax. Is that correct? Let me think if I've got this. I believe that answer is correct, because right. I believe what they're saying is we're gonna recognize income that's not taxable, which is in the form of the forgiveness of the loan.
Right.
That's an M1 adjustment number one, and then we're gonna not recognize the deductible expenses as deductible, but instead they're gonna non-deductible. So that's adjustment number two. So I think that's correct. That's yes. Is that the way you heard it too?
Yep, that's exactly how I heard it.
Okay. Can we carry accelerated depreciation back to 2020? Oh, that's the same question. Can we carry accelerated depreciation back to 2020 from 2021? And I don't think that's on the books right now. I don't think that's an opportunity. So you want to push as much as you can into this year as you can.
Yes.
So if I have an LOL, I can carry that back. I don't want to extend my 2020 tax return. I want to file as soon as possible, right?
Yes. Yes.
This is one of those weird spots, isn't it, Bonnie? You're kind of caught, because if you file quickly, we may lose out on the fact that the IRS and Congress may change the rules to, again, allow for deductibility of those expenses. But the sooner we file, the sooner we get our cash back. So what's more important in that situation?
File sooner to get the cash back, because to your point, if there was some act passed by Congress, you would be filing an amended return. So
I love that. Great advice. Yeah, cash is king, right? Get that cash in. Let's see here. Okay, this I know this gentleman. He's always got great questions. What if we are small potatoes, sole proprietors? We got a $40,000 PPP loan, went to pay all partners as distribution to partners. We'll have a net loss of about $20,000 this year, even if the 40K is listed as other income. No 2018, 29 carry forward losses available. 2021 income is very questionable. I assume we apply for forgiveness right away and just let our partners pay the income tax. I think he's almost right. Not quite.
I'm looking at this question because there's a story.
Yeah, I don't think that's entirely right. I think you want to apply for forgiveness right away, but I do think you can take that loss and file back to 2018 and 2019. You can take the 2020 loss.
Okay, yeah, we'll have a net loss of about 20,000 this year.
Mm-hmm.
Even if the 40 is listed as other income. Okay, so you're at a $20,000 loss with that income added back in. So yes,
yep.
you could carry that back.
Yep. Okay. I got some clarification from our government contract person. He was talking about overhead rates for years in the future. And he's right. I just don't know what effect I don't know if taxes are going to affect those overhead rates or not. And that's where we want to think about it. All right, let's see. I've been told that the best thing to do is use PPP funds for only payroll expenses over the 24 weeks.
I can comment on that.
Yeah.
That is I can see where that advice is coming from as far as ease of tracking your expenses and reducing the amount of supporting documentation you're going to have to provide the bank. So I do have clients where initially we were planning on, submitting the occupancy costs and the payroll costs, but the payroll costs paid out over 24 weeks exceed the loan like more than 2 times. So we're just using payroll because it's only one thing we're having to submit. But there can be some strategy with that. If there's any reductions to forgiveness applied because of the way the CARES Act laws are, so if you reduced headcount at all, if you reduce the average pay by any employee's pay rate, and it's reducing that forgiveness amount, you might want to add in, all the eligible expenses that you can to get back up to the maximum forgiveness amount. And this is definitely something that we can talk to you about and that I've worked with my clients on, as I said, the past several months.
Yeah, I think one of the key things is making sure that you get that forgiveness and do whatever you can to get it. All right, 2 more questions here, and then we're gonna wrap it up before the top of the hour. Do I need different documentation than what was provided with my forgiveness application? We spent 100% on payroll.
Do I need different documentation than what was provided? So I'm guessing that this question is meaning different documentation for the tax side of this.
I don't think so. Well, it's interesting. Maybe I guess that must be, it must be around the tax side of it.
Yeah, because I was trying to think different from what. I would say that as far as what you're providing the tax preparer, provide the same thing. That's what you're using to apply for forgiveness. That's what should be provided. And similar if you haven't yet provided, but you have everything packaged up. So whether or not a lot of banks have had a really slow process in building out their applications online. So if there's a case where you haven't yet been able to apply, just whatever support that you have together that you're going to use to apply. And I do want to say as well, something that kind of snuck in PPP updates in the last, I guess it was last couple months, is that they announced that for PPP loans of $50,000 or less, these are basically automatically forgiven. So there's not really support to provide. It's kind of, it's forgiven. So if your loan's less than $50,000, you really just have to fill out a form. They don't require additional documentation.
Well, that's great to know for a lot of our sole props and small businesses. That's super helpful.
Yep.
So the last question is an interesting one because I'm confused. My understanding was the taxable income from debt forgiveness is taxable, but deductions are deductible. So in the end, it's a wash. I think what the frustration is coming from is that is the way it was done before 2020, before all this weird stuff happened. If you got forgiveness on a loan, it became income taxable to you. Pretty simple. Today, what Congress did in March of this year was they said, no, we're going to give you a forgivable loan that would be non-taxable to you. And then later, the IRS came back and said, okay, that's fine, but whatever you used it for is non-deductible, so it has the same effect as it had before. So the key here is trying to get as much forgiveness as possible and making sure that then you're thinking about what you've got to do from a cash flow standpoint. So Bonnie, I just want to take a second to recap what I've learned here today and make sure that I got all this stuff. I got a bunch of notes, so I want to make sure that I got all your stuff. So what happened here is the IRS clarified their position. Effectively, the PPP is taxable to us, which sucks, and it doesn't look like on the horizon there's any way that that's going to change. So go ahead, get your forgiveness as quick as possible, and then figure out what you got to do. Because the first thing you got to do is make sure you can pay your taxes by January 15th. Know your 13-week, that was a good one that I took away from you. Know your 13-week cash flow forecast. I still think we have a downloadable 13-week cash flow forecast on our website available. That's our form that you can easily fill out. Use that to figure out what your 13-week cash flow forecast is. That's very, very important. You got to really start planning today. I think that's critical. We only have, for most of us being cash basis taxpayers, you only have another, 28 days until we're done. So get on your horse. There's 4 weeks left to make sure we get this thing done right. Then think about all the stuff. I loved what you were saying about these net operating losses. These are a huge piece of the CARES Act that not many people are taking advantage of because you can carry it back 5 years and you can get cash today. So think about what that means for you. Then think about capital expenses and what you can pull into 2020 to reduce that income immediately so that you can deduct that. And then the interest deductions, the 50% cap versus the 30% cap that used to be there. Those were good things to think about. The other stuff that I heard is really make sure that you understand where you're at here coming to your end. You've got to know whether you're in an income position after these non-deductible expenses, or if you're in a loss position after these incoming expenses. So get November reconciled as soon as you can. Make sure you've got financials through November and projections through the end of the year so that you can make accurate forecasts and do this thing right, because you really only got one shot at it here over the next 28 days. Anything else that I missed here? And then the Main Street Loan Program is ending, so hurry up and get in there. That's kind of what I heard. Anything else that I missed?
No, I think that was a really great summary. Can't emphasize enough to start planning, and as much as you can, don't panic. Matt and I are here. You'll have our email addresses, and we can help guide you and answer your questions, that you may have as they come up. So.
And there are our email addresses right there. One thing I really want to do is thank everybody who helped put this on and helped put this together. Bonnie, thank you for all the energy and expertise you have put in to understanding this stuff and interpreting it for our clients and for the community this year. It's been a tremendous effort. I want to thank our other CFOs, Andrew Ruff, Bruce Lambright, Ryan Larson, others that have really put in a tremendous effort in getting this stuff correct from the beginning. I also want to thank Katie McKillog, who helps put all of these things together and gets all of our technical stuff ready and out there. So thank her for all of her hard work, and the rest of the folks at TGG University, James and everybody else, Emily, they just do a wonderful job in helping us get the information out to you. Once again, if you've got any other questions, there's going to be two things. First, all of you who signed up are going to get a copy of this recording. It's going to come back to you in an email, so you can all review that. You've got our email addresses here. We are here to help and want to help as best we can between now and year end. And if not, we'll help you next year too. So thank you all very much for your time. Appreciate your attendance. And Bonnie, thanks again. Your expertise was absolutely invaluable.
Thank you, Matt. Thanks, everyone.
Bye, everybody.